Warren Buffett, also known as the Oracle of Omaha, has become one of the 5 richest people in the world, starting with an investment of only $1,000. His investment style is followed by thousands of investors globally. If you want to know what have been the characteristics, his investment style, and what principles he applies when investing, you should pay attention to this video. And if you want to watch the video, I just ask you to like, subscribe to the channel if you have not already done so, and share this video on your social networks. Above all, with a friend who is as eager to prosper as you. Are you ready? Come on. Warren Buffett follows this rule: think like the owner of the company. And this phrase means that when you invest in a company you must have a very long-term vision. So you should not see the shares as little numbers that go up and down, but as the proportional part of a company. Let's see, Warren Buffett has 2 criteria for choosing stocks. The first and most important is to fully understand what the company does. An example, in the year 2000 there was a financial bubble called the dot-com bubble. Dot-com companies were internet-related companies that had a fast-growing stock market, and everyone wanted to hold these types of stocks in their portfolios because of their rapid growth. Well, Warren Buffett didn't invest a single dollar in these types of companies simply because he didn't understand what they did. He didn't understand how these companies added value and generated value, so he avoided losing a lot of money in the stock market. Warren Buffett prefers to invest in companies that everyone knows and knows what they do, for example McDonald's or Coca-Cola. They sell hamburgers, and they sell a soft drink, it's as simple as that. Warren Buffett's second criterion is to choose companies with a strong competitive advantage, companies that could be said to have a consumer monopoly. A clear example is Apple. Apple has its own operating system and its own devices, and people who are suited to that environment don't want to leave. Warren Buffett is a proponent of diversification, but not too much. In fact, he thinks that diversification is for investors who do not have clear ideas. He does not like portfolios with many stocks and many sectors because he thinks he cannot control them well, and for this reason he only focuses on buying excellent companies. An example of how Warren Buffett works is the purchase of American Express in 1964. This company suffered a sharp fall in the stock market, and Warren Buffett invested 40% of his capital in buying 5% of the bank. The move worked out well for him, but it is almost half of his wealth in a single investment. I personally am in favor of diversification, but a controlled diversification, especially at the beginning. Buying stocks of different companies protects you, but it also dilutes your profits a lot. You should always have cash and liquidity on hand. This is an opinion that I share. You should have enough liquid cash to survive 5 years without working to be safe and secure. Warren Buffett keeps at least $20 billion in liquidity in his investment company. And you may ask yourself, is liquidity that important? The answer is yes. If you are going to dedicate yourself to the business and investment world, you must always have liquidity. Having liquidity in the bank gives you many advantages, for example, to face unforeseen events. In case of any unforeseen event you will have cash to be able to solve it, and above all to take advantage of investment opportunities. If there are strong falls in the stock market or in a specific company and you want to take advantage of it to buy securities, you can only do that if you have a lot of liquidity. There is a phrase that sums it all up. Liquid money is to a business as oxygen is to people. We don't realize it is there until the moment it is missing. So always have liquidity at hand. The price you pay for your shares will determine whether your investment will be good or bad. Pay less and you will get more, pay more and you will get less. Warren Buffett uses a very popular stock market ratio, the EPS, which is the earnings per share, to select companies. Finding the EPS is very simple. We simply divide the company's profit by the number of shares. This ratio gives us real information about the profit we get with each of the shares of a company. Let's see an example. Imagine that a company has obtained a profit of $50,000 and we divide it by the number of shares, which are 10,000. The result gives us an EPS of 5, earnings per share of 5. The earnings per share alone does not tell you anything. You should compare it with other companies. You can also find the average EPS of a sector and compare it with different companies. Another popular ratio derived from EPS is the PER, the price to earning ratio. To find a PER in the stock market, we simply divide the share price by the earnings per share. If we continue with the same example, imagine a company whose shares are trading at $30. If we divide it by 5, which is the earnings per share, we get 6, giving us a P of 6, a very good P to tell the truth. Price is Warren Buffett's main philosophy. If Warren Buffett comes across a well-run company with good management and a good product but the stock is expensive, he will never buy that stock. On the contrary, he will show his patience and wait for the stock to be priced correctly. Warren Buffett makes it clear at all times that time is the ally of good businesses and the enemy of mediocre ones. But this phrase, Warren Buffett makes clear his preference for buy and hold. The strategy is very simple. It consists of locating undervalued companies and adding them to his portfolio. You may think it is a simple strategy, a boring strategy, perhaps, but the truth is that Warren Buffett, through his company Berkshire Hathaway, has managed to beat the main Wall Street indexes.
Testing 1 million, 2 million, 3 million, yeah, right, okay.
Let's take a look at the chart. As you can see, the S&P 500 always goes up. Whatever happens and whatever ups and downs it has, it always keeps going up. This is proof that investing for the long term is efficient. Now you are looking at Warren Buffett's company, Berkshire Hathaway. This company is a conglomerate of companies. It is the company that Warren Buffett uses to invest in other companies. We have data on this company since 1990, and as you can see, the chart always goes up. Warren Buffett also does well. He does just as well as the S&P 500, but why waste time buying and selling stocks if I can index all my money to the S&P 500? Well, let's compare this company with the S&P 500 and see who wins. What you are seeing below is the overlay of two charts, the comparison of two charts. The top one is Warren Buffett's company Berkshire Hathaway, and the bottom one is the S&P 500. The result is that, while the S&P 500 has appreciated over 600%, which is very good, Warren Buffett's company has appreciated over 3,700%. Undoubtedly, the numbers do not fail, and Warren Buffett's strategies work. Warren Buffett told a very interesting anecdote. He said that initially there were 3 partners and 3 friends, Charlie Munger, Warren Buffett, and there was a third partner named Rick Guerin. Today Rick Guerin is not well known or talked about regularly, but in Warren Buffett's words, he was as good an investor and as successful as he and Charlie Munger could be. His problem was being too ambitious. He wanted to make more money or get richer faster than would have been possible, with a more normal pace as practiced by Warren Buffett and Charlie Munger. And with the market crash of the 1970s, he was using leverage and debt, so he was forced to liquidate his investments at knockdown prices. In fact, Warren Buffett had to come to his rescue and buy his shares in Berkshire Hathaway, their joint holding company. Today he is an investor who is not much talked about, he is not very well known, and that leverage took him away.